It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. Chinese shares lead losses in Asia. Investors sending a signal to Beijing for more stimulus as holiday spending lags pre-COVID levels. In what would be a historic antitrust breakup, the U.S. Justice Department may recommend breaking up Google to end its monopoly in online search. Also ahead, South Korean bonds to join FTSE Russell's major global index next year, while India wins addition to the emerging market gauge. And Hyundai Motor seeking to raise more than $3 billion through an IPO of its Indian unit, kicking off the country's biggest ever listing. Let's get to markets and Avril Hong. And of course, Avril, we saw that relentless rally in the US, but not the same story in China.
Yeah, it is not partaking in those gains overnight. What we're seeing in China is really an underperformance versus the broader Asia markets, which initially left the region's benchmark with gains, but ultimately succumbing to that pessimism after the holiday spending data. We are seeing these stocks in Hong Kong in negative territory, extending the decline from a day ago where it saw its worst day in 16 years. We're also seeing the mainland stocks all but erasing yesterday's gains. And of course, this is coming against the backdrop of that underwhelming NDRC. Not enough meat on the bones, no clear plan as to solving the housing slump or even to reviving consumer sentiment in China. So that is what we're seeing in terms of the mainland, but also wanted to focus on what we're seeing on the RBNZ today. It cut rates 50 basis points. This is as expected, yet we're still seeing quite steep declines on the Kiwi dollar. And this is coming after comments from the RBNZ suggesting that it sees financial conditions currently still restrictive, and this suggests that it could see more easing to come in the days ahead. We're also seeing bonds in New Zealand climbing. Let's flip the board because, as you know, Haas, yesterday was a really wild one for Chinese stocks. And just to give you a sense of how extreme it was in terms of turnover on the mainland as well as in Hong Kong, we saw it at a record, biggest ever trading frenzy. We're hearing about people rushing to open new accounts. That is the state of play at the moment, Haas.
Right. Trepidation, frenzy, you name it. Avril Hong, thank you. Let's get to Raisa Rasid, global strategist at JP Morgan Asset Management, to discuss more on the markets. Good to have you with us. Lots of questioning about whether that sell-off we're seeing in China is consolidation or capitulation.
No, thanks for having me. And I think firstly, let's just go back and think about the Chinese equity rally. And it is really liquidity market driven. And what that means is that we've seen the multiples really re-rating upwards. And that's a function of all the policy measures that were announced, moving from the housing as well as the equity market, and really the optimism around the fiscal stimulus policies right now. So on one hand, monetary policy that we've seen coming through, your triple R cut, your policy rate cut, that's great in terms of limiting that growth downgrade in China that we've seen, but what investors want and what they would like to see is really that fiscal stimulus coming through. And I think right now markets expectations are really high, so any disappointment in terms of the delivery front on that fiscal policy would result in the pullback, and yesterday morning was the perfect demonstration of that really happening right now. So what we're looking for to see in the coming weeks or even months is really any announcement from the Ministry of Finance, as well as any announcement of measures being put forth at the MPC Standing Committee later this month.
There's a sense that China is not really in a hurry. The question really is whether it can afford not to follow through with the fiscal measures, because it's not just international investors, but also domestic investors.
Yeah, no, I think that's a great point. And, you know, when we just look at the Golden or the National Day holiday data that's coming through, yes, you did see some pickup, but it's not overwhelmingly strong as well. So I think there is some trepidation as well for the domestic onshore, investors in China and the consumers. At the very crux of the issue in China, it's really the private sector balance sheet that need a lot of repairing. So what policymakers really have to do is address that confidence issue that has been lacking in the past. So yes, all the policy optimism and the coordination of policy measures being put forth is positive, but any short of the follow-through would really be manifesting itself through such pullbacks that we could potentially see in the coming months as well.
How deep a pullback? If China fails to follow through, might we then see capitulation? We have been here before. Markets have been disappointed many times before.
Yeah, so I think the whole idea of the false dawn and the whole reopening story, etc., that we've seen in the past, that is a risk. But I think what makes this time different is that there is a willingness of policymakers in terms of the coordination of various agencies, which we have not seen before. So, and the range of the policy measures really has been a little bit more broader this time. So you have the housing market, the equity market in terms of the lending and the swap facilities as well. You did see that whole fueling of brokerage accounts being opened by Chinese consumers as well, Chinese investors. So really what we need to see is that fiscal. Anything short of that, though, we could continue to see events of yesterday really coming through again.
It sounds like glass half full. So would it be buy the dip? And what would you be buying?
Yeah, so I think when it comes to in terms of buying the dip, I think what we need to see first is really follow through. So without that, I think it would be a bit tricky. But in terms of, investing in China, we do tell investors to take an active management approach to China. There are opportunities in China when it comes to technology, when we talk about communication services sectors as well. We've seen some of these companies really kind of repair their leverage situations, and earnings have been delivered as well. But what we really need to see is a change in the landscape in terms of the growth optimism in China to really turn the investor sentiment around in China and really bring in those flows in a more sustainable manner. So in short, yes, we get the valuation re-rating, but we need the earnings being delivered. Anything short of that, the lack of the sustainability of this rally.
You talked about growth. Is growth what's key to China right now, as opposed to fighting deflation? All the measures that I've seen so far, monetary policy front and center, is that about getting to 5% growth?
I think the fact that they do put that 5% target level, it's a very overt goal. And so they would do everything, and I think it was mentioned yesterday as well, that they would take all the necessary steps to actually achieve that. But I think it's both. I think you can't really disentangle between the growth and the deflation story. So I think all these fiscal stimulus measures that are coming through are really aimed at addressing both of the issues in China currently.
Okay, we've heard time and time again as well, we want more. We want more. How much more? I mean, we have the likes of HSBC, Morgan Stanley saying 2 trillion yuan. Others say, I think it's Citi that said 3 trillion yuan. What is enough? And is that enough? If we see those numbers, is it enough to turn around significantly the Chinese market?
Yeah, so I think what markets are really expecting is somewhere north of that 2 trillion. 2 trillion is something that is really in the playbook of what Chinese policymakers have done before. But it's not only about the quantity. We can talk about 5 trillion, we could talk about 6, 7 trillion, but really is that composition of growth of the fiscal stimulus measures that really need to be put forward. Are they going towards consumers' pockets, for example, in terms of consumption handouts, etc.? So I think that's really, really key as well. So I think before we get into what's the right number, I think compositionally addressing that investor consumption's lack of confidence, income expectations that are in the doldrums right now in China, it's really, really hard to actually pinpoint a number, but really composition matters in terms of what sort of measures are being put forth.
And how closely is China, how closely is the PBoC watching the Fed? 50 basis point cut, great, but it may not be cutting maybe again next year, at least some say. I mean, how is that playing into China's own policies?
So, I mean, the impact on the Fed to the PBoC, for example, would really be critical in terms of how we think about the yuan, for example. But I think right now, the Chinese government and the PBoC, by extension, really would be focusing on how they need to really reflate the domestic economy. So I think that is critical right now. So you are going to see, if need be, more monetary policy cuts to really kind of get that 5% goal. Again, it's a goal that they put forward, so it is something that they're going to work towards.
And of course, the U.S. election, a risk to China as well.
Yeah, that is an overhang right now. I mean, we're, 2 weeks away? So I think any policy measures that, could be curated, like, in the next couple of weeks, I think that could have a major impact on China and, by extension, the global supply chain.
Oh my God, it's just 2 weeks away. Raisa, hang tight. Raisa Rasid, global strategist at JP Morgan Asset Management. Still ahead this hour, India's central bank is set to announce its latest rate decision in just over an hour. HSBC's chief India economist will be joining us very shortly with what investors should be watching. Keep it here with us. This is Bloomberg. Welcome back. FTSE Russell is adding South Korean bonds to its benchmark index, capping months of official campaigning and an overhaul of market infrastructure. The index provider will also add India to its gauge of emerging market debt. The global head of FIC Index Policy, Nikki Stefanelli, told us more about India's inclusion.
Based on feedback that we've received, we also announced inclusion of India for our EM index, which again kind of has the accessibility expectations calibrated to that peer group, which is of course different from a largely developed market index like the WGB.
So in terms of New Delhi, what sort of changes are you expecting to see? What would you like to see in order to make it easier for global investors to access the market?
Well, India is not kind of a candidate for the WGB at this stage. WGB does have kind of those really high expectations in terms of accessibility. Importantly, it also requires that the markets have a minimum credit rating of single A. So it's not on our radar at this stage for inclusion into WGB. It's really kind of a decision that's really oriented around those EM global portfolios.
FTSE Russell's Nikki Stefanelli with our very own Sherry on. Let's get back to Raisa Rasid, global strategist at JP Morgan Asset Management. Raisa, I mean, you've got to imagine that this is good news, right? There's been rising interest in Asian debt anyways.
No, I think a lot of these has been priced in as well. So, bond inclusion, etc., especially in Asia, that's something that we've been talking about for a while. So it's definitely very positive for Asia in general. But when we just take a step back and think about fixed income and what it really does to your portfolio, it really does provide that sort of cushion in case we're talking about a broader cyclical slowdown, especially in the US, that could really spread across the rest of the world. So fixed income itself is something that we are, pushing investors to have in their portfolio, and really moving towards Asia away from the US would really provide that broader investment opportunity set for investors that really seeking that flexibility as well as seeking alpha. And when it comes to Asia, taking advantage of the deferring central bank rate cutting cycles, that would be very key.
So how do you take advantage of that? How should it be looking like? What are you buying?
Yeah, so when you just think about the US, right, when you just look at some reports that could really change the perception of what Fed it could do potentially, and that last Friday's job report was a perfect example where the 50 basis points cut was really started to being priced out for the month of November. So that really kind of decreased the likelihood of a more aggressive rate path for the Fed. Whereas in Asia, we've been waiting for a while for the ability for some of the central banks here to cut rates. Inflation was already back on target for a lot of these central banks, but the financial stability concern in the form of currency depreciation was really stopping some of the central banks from going ahead to cut rates. But we've seen the BSP, we've seen Bank of Indonesia gone ahead as well. We're going to see more from India. We're going to see more from Korea, etc., going ahead. So that really, really bodes well for Asian fixed income markets as well.
There has been anticipation that India would move. Would it move today?
Yeah, so I think it's a bit tricky for India as well. So what we think is that they could start to hint that they could move to neutral before they do cut rates in the coming months right now, because we do look at the commodity markets very, very closely, and India being a major energy importer, that would really have an impact on inflation for where crude oil prices are going right now. So I think for RBI, they do have a case on their hands to cut rates, but I think the inflation story will be on the back of their minds and could just make them be a little bit more patient and just wait a little bit longer to see how commodity prices could play out, especially given how the geopolitical tensions are evolving in the Middle East.
What if the RBI moves today? What would it mean for markets?
So I mean that's great for some of the India fixed income markets, right? And again, I think that markets are pretty much split on what RBI is going to do, in the upcoming meeting as well. But I think more generally, if you just take a step back, Asian fixed income is a place of opportunity. I think if you just look at the growth backdrop in some of these countries, the services-oriented sectors, they are doing well. Chinese policy stimulus coming through, that's going to be a tailwind for some of the other Asian economies, whether through tourism or the more structural factors of the shift in supply chains, for example, really benefiting some of the Southeast Asian countries. So I wouldn't just necessarily think that India could be taking advantage of it, but really a broader Asian fixed income allocation would be a good opportunity for investors.
So you're liking Asian fixed income. How about Asian stocks? Because we talk about how perhaps, the U.S. equities are overstretched and perhaps Asia is the place to be, but not really, because that's where you find quality in the U.S.
Yeah, so I agree with you. U.S. will always have that quality bias in it. But what we're telling investors is the importance of allocation or U.S. and having that diversified allocation away from the U.S. to really mitigate that U.S. concentration risk that we're seeing right now. So given the whole idea of potential tariffs or the escalation of tariffs, geopolitical tensions, we do think that there are opportunities in Asia. When we talk about artificial intelligence, for example, you do see the beneficiaries of the North Asian markets. But on the more consumer electronic side, Southeast Asia, those are the key beneficiaries as well. And if you just take a step back and think in the medium term, we do have favorable demographics working in our favor. And again, anything that happens on the geopolitical front, that would really benefit that supply chain reintegration of the Southeast Asian market into that global supply chain.
Speaking of tech, we have the question of the day, and it's to do with the NASDAQ. How long do you think before the NASDAQ makes a new high?
So I think this really underpins what we think about the Fed ultimately as well. So if we do have certainty that the Fed is going to cut rates, more at least at a gradual pace, and you don't going to see any pullbacks of such, then we could see some of the growth stocks in the NASDAQ index really do well. I think when it comes to tech, yes, valuations are high, but we do believe we do have the strong conviction of the AI story as well. It will take a little bit of time to reconcile investors' impatience on when they're going to see the return on investment, because it will take a while for data centers to be built out, etc. But at the same time, you do see other opportunities that really could take advantage of the AI story, for example, utilities. So we do think that NASDAQ could see the light of day again as the Fed continues to cut rates. I think we do have that conviction that the Fed is going to go in November and December at the 25 basis points pace, barring any shocks.
How about in terms of the dollar? How much conviction is there?
So on the dollar, we do understand that it's very relatively weak right now. We do think that in the medium term, the dollar could weaken. But ultimately, the U.S. growth backdrop will be very key to that story right now. And if you just look at the jobs report on Friday, that is really a realignment of the incoming data that we've seen more broadly that really points to a U.S. economy that's still relatively resilient and really strengthening or bolstering our case that the soft landing narrative is really still very much in place.
Keep a watch on that inflation data coming out on Thursday. Raisa, thank you so much for your insights today. Raisa Rasid, Global Market Strategist at JP Morgan Asset Management. Now, Hurricane Milton is now set to hit Florida's Gulf Coast later Wednesday after regaining Category 5 strength with winds of 260 kilometers an hour. Officials say flooding and high winds may inflict widespread damage and put lives at risk. Milton could potentially deliver the Tampa Bay area's first direct hit from a hurricane in a century. The region is home to more than 3 million people, NASA's Kennedy Space Center, and Florida's largest port. Well, plenty more ahead. Keep it here with us. This is Bloomberg. JP Morgan CEO Jamie Dimon says the Fed was right in making a 50 basis point rate cut to avoid recession and tackle rising unemployment. Dimon spoke exclusively with Bloomberg, also weighing in on the U.S. economy's trajectory and market valuations.
Soft landings are hard. I hope it happens. I don't know. I just wouldn't count my eggs in that one.
Do you think
and markets are open. When you say open, they're very, values are high. They're not low. Both equities and bonds credit spreads are very low. So they're open, but people are saying they're not open for IPOs. So some IPOs, when we just did one of the largest ones of the year, like last week, they're open for those who the market wants to buy today. But don't assume that they're not open. And, sometimes people would go public, they don't like the price. That's a very different thing. And you should think twice about that when you think you know what a company's worth much more than the market might know.
That maybe it's an assessment of what you're looking for rather than the actual market being closed.
Exactly.
You said that there are a lot of inflationary things that are coming down the pike. Do you think that it was a mistake for the Fed to cut by 50 basis points?
No, actually. I mean, you got to separate the here and now. Inflation has definitely been coming down. They don't want to go into recession. Unemployment has been going up. They raised rates. They were late raising rates, but they raised it very high, rapidly to 5%, which I think is the right thing. And they're right to take their foot off the gas in that one. I don't think it matters that much, 50, 25, honestly. But I think that was okay. If inflation comes back, I'm looking at future things. The remilitarization of the world's inflationary. The fiscal deficits of the world, particularly the United States, are inflationary. The green economy is inflationary. Demographics are inflationary. It's very possible energy prices down the road, I'm talking about 2 or 3 years, will be inflationary. Those will hit later. They should react at that time to those things, but I don't think you can anticipate that. We don't know that that's going to happen.
I'm so glad you brought up the deficit. I watched the Treasury auctions. There's another 3-year one today. I watch them every time wondering, are we going to start seeing disruption from some of the concerns that that you bring up, but also every single investor who I speak to says the same thing. Are you surprised that the market hasn't priced in a higher structural deficit in the way of higher yields or at least more volatility, at least at auctions?
Yeah, well, I have a lot of comments on that one. Commodity markets often don't price things in until they actually happen. And so it hasn't happened yet. The higher inflation, the higher structural stuff, even though the deficits are there. There's also sentiment, inventory, supply and demand of capital goods. So it's very hard to say. But that's why I think that longer rates may actually stay here and tick up a little bit as opposed to go down because of these huge deficits in the United States. And then the market's reacting, which the word you used of volatile or something like that. It's not always bad. I mean, I think we overreact sometimes to volatile markets, but I do think they'll happen again. Dealer inventories are very low. Banks are, the big market makers are very constrained. Not today. I mean, we have this anomaly where JP Morgan is going to have $1 trillion of cash and unable to intermediate in treasury markets or repo markets completely conservatively because we're required to hold that cash in very, like central bank reserves, something like that. So I think when QE finally gets to a certain point, you will see that. I may be wrong. And again, if it happens, I don't think it's a disaster. It's not bad for JP Morgan. I do think policymakers will get upset. They don't like seeing that type of thing. And I think there are fixes to it, and I think they should start working those fixes today.
And that was JP Morgan CEO Jamie Dimon speaking exclusively with our colleague Lisa Abramowicz. In the markets, we're tracking China extending losses for the day, down about 6% right now. It was down as much as 7%, reversing all the gains that it clocked just yesterday. CSI 300 index down about 6% as we speak after a wild trading day yesterday, set for its first loss in 11 days. A clear message. Traders are disappointed with the NDRC presser showing no powerful fiscal stimulus was announced to back up the monetary measures that have been implemented. The Hang Seng Index down 2.2%, extending the loss it clocked yesterday as well. Remember, though, for the year, it is up about 20% or so. In terms of the Chinese yuan, 706.82 versus the USD, flat right now. Well, taking a look where we are in terms of those commodities, also under pressure on the back of that lack of stimulus from China. Shanghai crude down 2%, copper lower by 1%. Plenty more ahead. Keep it here with us. This is Bloomberg. Markets on edge, China in particular. Let's do a check-in on how markets are faring with Avril Hong in Singapore. It is about China, it is about Hong Kong impacting sentiment, Avril.
Absolutely. I mean, take a look at the picture as we head into the lunch break on the mainland. I wish I had better news for you, but we're seeing these declines on the CSI 300, erasing what we saw just a day ago. And this is the steepest loss we've seen since February 2020. If you take a look at the mainland as well as the Hang Seng benchmark, this is the lowest level in 2 weeks. So clearly, the signal we're getting from investors to authorities, they want to see more in terms of stimulus. And for the likes of Goldman Sachs, Tim Mo, they say think of this as a purging event of sorts, clearing out inflated stimulus expectations. And of course, this is against the backdrop of that debate raging on whether this is correction or capitulation we're seeing in the market. So this is Chinese equities picture. Flip the board. I also wanted to take you to what we're seeing out of India. Of course, we have an RBI decision due later today. Not expected to change on rates, but we could see a bit of a shift to a more neutral stance from the hawkish stance currently from the Reserve Bank of India. That could be something that's helpful for India bonds. We've seen them slumping in the past week. A day ago, they did climb though, and this is a bit of positioning ahead of the FTSE Russell announcement. Of course, it has said that India as well as South Korea will be added to its EM bond index. We are seeing a bit of steadying on the rupee around the 84 handle, a bit of a climb on the 10-year in India bonds. Flip the board again. Let's take you to Japan. One of the stocks in focus, the convenience store giant 7&I. Today, we're hearing how Couche-Tard, the Canadian firm, is said to have upped its offer for 7&I by about 20% from its prior offer to $47 billion. The stock shot up about 12% initially, paired those gains. And as we come back from the lunch break, it's hovering with gains of about 5% still. And this is on a day where if you take a look at the broader Japanese benchmarks, they are still in positive territory, tracking more or less what we saw on Wall Street overnight, but they have paired those 1+% gains. Tech stocks are doing pretty well today, Has.
Avril Hong, thank you very much for that. And speaking of tech, the U.S. Justice Department says it may push to force Google to sell off parts of its operations. In a court filing, the DOJ lays out other potential remedies to judge who found Google illegally monopolized the search markets. Let's get more with our tech reporter, Annabelle Drulis. Bell, this would be a historic antitrust breakup.
Yeah, it's certainly very significant proposals that the DOJ is putting forward to the judge who found that, as you said, Google had illegally monopolized the search market. So we've had the ruling, and now it really comes down to the remedy and what are the types of solutions here. So the DOJ has put together a 32-page document. They put that filing in on Tuesday, late in the day there, but essentially talking about these different solutions, behavioral, structural ones that can essentially prevent Google from using its products at the expense of others in the market. So some of the measures that they're proposing, well, at the most extreme end, it would be about forcing Google to sell off parts of its operations. As you said, that would be the first time we've seen Washington pushing to break up a US tech giant since Microsoft about 2 decades ago. And that attempt was unsuccessful as well, we should note. But what else they're looking at is pushing Google to allow websites more ability to opt out of its AI products. They could also be looking at forcing Google to provide access to underlying data that it uses to build search results and AI products. So lots of different solutions or possible solutions in the mix. Of course, this is really not what Google wants to see, and they're really preparing to push back quite strongly against this as well.
And you would imagine, Bell, that Google is up in arms and trials could go on for years.
Yeah, that's right. I mean, Google's already come out with a statement and they're saying that they're looking forward to putting their case back into the court system in about a year's time from now. But as you said, yes, these sorts of things can go out over a number of years. But what they're saying essentially at Google is that the findings or the blueprint that's been put forward by the DOJ goes far beyond the scope of the court decision about search distribution contracts. And so they're essentially framing this as a type of government overreach that it says would hurt businesses and consumers, and it would also have really big impacts for Google search itself. Of course, Google saying that they've put really billions of dollars into their products to date, and it would be severely detrimental to them. So they're saying that they would again have unintended consequences for the consumers, the businesses that use them. And as we said, they're looking forward, according to Google, to making their case in court.
Belle, thank you. Annabelle Jewell in Taipei for us. Now, still to come, we preview the RBI's rate decision with HSBC's chief India economist. Hear why they think the central bank is inching closer to a cut. That's next. Keep it here with us. This is Bloomberg. In the tech space, Hyundai chairman Young Liu says the company is planning to boost server capacity to meet stronger than anticipated demand for NVIDIA's AI chips. Speaking to us at the firm's Tech Day in Taipei, Liu disclosed for the first time how many servers they plan to make for next year.
We see the demand is over what we can ship.
So if you can't meet the demand right now, how long do you see that extending for? What sort of sales do you have booked going into next year as well?
We see in maybe somewhere around 20,000, that kind of a number.
You're looking to ship 20,000 AI servers made with Blackwell chips over the course of next year, is that right?
Right.
Okay, and any particular quarter that you're looking at in particular for that, or do you see it being
it's not
spread
per quarter,
out?
that's a year.
Yes, but per quarter, are you expecting a bulk of those to go in one particular quarter, or do you see it spread evenly across the course of this year, or next year rather?
It really depends on once we start shipping, the demand, whether the demand will change or not. If the demand doesn't change after we start shipping, and the demand will be even higher than we expected.
In terms of profit margin, then, what I understand for AI servers, it can be in the low teens. Do you see a way to expand that and to increase it?
I think in the low teens, you're probably right, but that will have to be based on how much vertical integration, how much components that you're able to provide. So with that, it varies to a certain degree. But because the CPU and GPU is very high priced, so the rest of the server, has only some limited impact in terms of overall cost.
That was Hyundai chairman Young Liu speaking with Bloomberg tech reporter Annabelle Jewell in Taipei. And in other news, Hyundai is seeking to raise as much as $3.3 billion through an IPO of its Indian unit in what could be the country's biggest ever listing. Let's get more details with our Asia Pacific Deals reporter, Manuel Baigori. Manuel, what do we know about the pricing, about the valuation?
Definitely an interesting one that has kept us really, really busy over the last few months. India is on fire. It's just such a booming market. Hyundai is just the latest and the biggest IPO to come to market. We just saw the news on the price range, somewhere that translates into around $22. And the valuation of the firm will be $19 billion. This is going to be the largest ever IPO in India, and it's going to be also very important to watch closely, as it will be a bellwether for other IPOs in the pipeline. So definitely one to watch closely over the next couple of weeks. Trading should start October 22nd. That's the schedule as of now, and the books will open to receive orders in the coming days as well. So definitely one to watch and one that is keeping us real busy.
You said it, euphoria in the Indian market. What are the next steps from here, Manuel?
Yes, so the next steps starting next week, books will open and they will start getting binding bids from investors. They will also start lining up some anchor investors. We understand, based on our reporting, that there is already very, very solid demand from a mix of international and local institutional investors. So the usual suspects from insurance companies to pension funds, sovereign wealth funds, and so on, and asset managers, of course. So those are lining up, and we'll start getting binding bids early next week. And then the books will close a few days later to potentially do the listing ceremony on October 22nd. So that is kind of like the timeline for this mega IPO, and there are more to come in the horizon as well.
Manuel, thank you so much for that. Our Asia-Pac deals reporter, Manuel Baiguri. Now, speaking of India, you're watching India Focus. We're counting down to the India Open in about 4 minutes from here. Of course, we know that Indian funds have bought more than $1 billion of shares daily for 3 straight sessions through Monday. That's helping to absorb the large sell-off by foreign investors amid a rotation into China's rebounding markets. But not happening today. Sensex currently showing a higher open, up 0.4% gains too for the other benchmarks. In terms of the Nifty futures, currently flat at 25,155. Now, it's also the RBI rate decision day. India's new monetary policy committee may lay the groundwork for an interest rate cut when it announces its policy decision in less than an hour. The market consensus sees the RBI staying on hold. Our next guest is one of Bloomberg's top-ranked economists for her RBI policy forecast. She says a change in the policy stance could pave the way for a quarter-point cut in December. Let's bring in Prajul Bandari, Chief India Economist at HSBC. Prajul, why do you think the RBI is likely to stand pat today?
Yeah, great to be here. So look, I think there are reasons why the RBI would soften its stance. And, in the past, it had a hawkish stance and now moved to a neutral stance. And the big reason for that is that growth on the margin is slowing a little bit. We've seen PMI numbers softening a bit. Tax growth numbers soften, passenger vehicle sales, cement production, a ton of urban indicators actually soften on the margin. We also don't really have a major inflation problem right now. Our sense is that inflation will go to about the 4% target by March 2025. And liquidity is pretty high with some of the short-end money market rates actually well below the repo rate. So given all of this, our sense is that the stance will be changed from hawkish to neutral in this policy meeting. But we're still not calling for a rate cut. And there are a few good reasons for this. I think number one, with oil going up and down in a major way, there's a lot of uncertainty around it. We've also got uncertainty from the US elections, only a month away. And then there are some optics. The next month's inflation data is likely to be a bit higher. So it won't be a great time to cut rates. So we don't think rates will be cut right now, but the stance will be softened, which will pave the way for a rate cut in December and then in February.
Pranjul, does the Fed matter to the RBI? We heard from Governor Das again and again that it doesn't, but a lot of the other central banks are looking to the Fed.
Well, I think India a little less so compared to many other emerging markets that we track, for example, Indonesia. But having said that, you can't completely ignore the Fed. So if Fed expectations change in a major way, what India does will also be impacted. But I think in this policy and over the next 2 policies, domestic factors will play a bigger role simply because we are seeing a change. We're seeing on the margin growth showing some softness, and we're seeing on the margin inflation pressures coming down. So I think domestic factors will be more important.
What's different this time round, Pranjul, are the 3 new external members. I'm just wondering what your thoughts are when it comes to how they might vote.
Well, look, it's a toss-up, and I think we'll know very soon in 45 minutes. But the truth is that, RBI has 3 of the 6 members, and RBI also has the veto power if there's a tie. So in a way, my sense is, RBI will get what it wants at a point when it's comfortable and it thinks policy needs to be softened. I think the MPC members will cooperate and the RBI will be able to soften its stance. So I don't see any big change just because you've got 3 new MPC members at this point.
How about in terms of the RBI's projections for growth and inflation? Do you think the RBI is set to stand pat on that, or will it take into account what's happening in the Middle East with rising oil prices?
I think one thing it can do is on the growth front, it's had a growth forecast which is higher than what markets expect, what we expect. It could nudge it down a little bit, and alongside the change in stance, my sense is that would open up the door for a rate cut in December. So a sort of lower growth forecast is something that we could see at this point of time. I would have liked to say that they could lower the inflation forecast as well, but maybe they won't because the uncertainty around oil prices.
In terms of growth, we're looking at 7.2% growth for India. Take a look at the demand forecast for us. We know that urban demand is slowing down, but that's compensated by rural demand. How are you assessing India's demand outlook?
Yeah, so I think there's going to be a pivot across sectors. I think the main driver of growth over the last couple of quarters has been urban demand, extreme exuberance there, but that is normalizing right now. What has been weak in the last couple of quarters or maybe years has been rural demand. There have been back-to-back climate shocks. Rural wages have been weak. Agricultural production hasn't been great. And my sense is now that a lot of this is changing. Temperatures have normalized, rains have been good, reservoirs are full. The next 2 crops could be very good. So we could see a pivot of demand from urban to rural. We'd probably stuck, in the middle right now. Urban is softening, but rural hasn't yet taken off. But my sense is by the December policy meeting, we will see rural taking off a little bit.
And of course, we'll know soon enough. Like you said, I'm just wondering, in terms of policy, what are you looking out for the most?
Well, look, there's the stance change that's going to happen. In our view, there's going to be rate decision, and our sense is that the RBI will stay put, won't change rates. But then alongside this, the RBI does comment on a variety of other things, which I think we'll see again this time around. One thing it's been saying for a long time to India's banks is to make sure that they don't lend too much in terms of unsecured loans and personal loans, bring down that bucket of lending, because that has gone a little bit into the unsustainable territory. And my sense is, that is something that will continue over in this meeting as well. So in a way, there is a little bit of a friction. There's monetary policy, and then there is financial conditions. Financial conditions in India have been pretty loose, as you can see from the stock market valuation, as you can see from banking sector liquidity. And my sense is that, again, RBI will do a little bit of moral suasion, telling people to hold back a little bit, telling banks to hold back a little bit, but probably not do anything concrete on that space.
Pranjal, thank you so much for that. Pranjal Bandari of HSBC. And of course, we're counting down to the RBI decision. Consensus is that it will stand pat. The question is whether it will tweak the tone from hawkish to neutral. And you can also turn to your Bloomberg for more on the RBI's rate decision. Go to TLive Go to get commentary analysis from Bloomberg's expert editors. Well, Indian Prime Minister Narendra Modi's party has pulled off a surprise victory in a closely watched contest in Haryana. The BJP won 48 out of 90 seats in the northern Indian state. The strong showing comes just months after the party's bruising loss of its national parliamentary majority. The BJP, meanwhile, saw worse results in separate elections in Jammu and Kashmir, where it won only 29 out of 90 seats. Well, still to come, Singapore's former transport minister trades private jets for a straw mattress as he begins his jail term. We have details just ahead. Keep it here with us. This is Bloomberg. Let's take it back to the Lion City. Singapore's former Transport Minister, as is Warren, is adjusting to a more grueling lifestyle after starting his 12-month jail term at the Changi prison. For more, let's bring in Bloomberg Asia senior editor Bill Ferris. And Bill, we know that conditions are tough.
They are tough. I mean, what a fall from grace. This was a man who was making about $1 million a year in a salary, who flew on a private jet to Doha and stayed at the Four Seasons. These were part of the crimes he was charged with. He is now at Changi prison on the eastern side of the island with a mat and a pair of blankets and very little else, and basically a solitary cell at the prison for a 12-month term.
But put that in perspective for us. How are the conditions in Singapore versus other cells in the world? We had the likes of Nick Leeson, who came out to say, you know what, the floors were pretty uneven, it was tough, but this was a long time ago. Have things changed since then?
The prison did upgrade its facilities. It even has a PR company that worked to improve its image after some of those early prisoners like Nick Leeson. Listen, there are worse places, I am sure, to be in prison in Southeast Asia or in other parts of the world. That's certainly true. I think Singapore has certain standards it tries to meet, even in its prisons. That said, what we know from people who have been there, including some who were there just until a few years ago, it's still a very uncomfortable experience, and it does look like it will be a very Spartan experience for the former minister.
But fair to say, the process is actually quite standard. It's just going to be a culture shock for someone of his stature.
Yeah, he is basically at this point living alone in a very small 7-square-meter cell. He has few, if any, personal belongings. You shower in the cell, you go to the bathroom in the cell, your food is taken in the cell, there's no communal eating. When he gets out 1 hour a day for recreation, that's also going to be by himself. So it's going to be a very isolating experience. And as one of the former prisoners we talked to said, when you lay in bed at night, you have nothing but your thoughts and often the guilt washing over you for how you found yourself in this situation.
And Singapore's been quite clear there'll be no preferential treatment, even though he was a minister before.
That's right, and I think a lot of people will be trying to check on that. Singapore says everyone will be treated the same, and it started with his processing at Changi on Monday.
All right, Bill, thank you so much for that. Bloomberg Asia senior editor Bill Ferris. Let's take you to markets. China, of course, front and center. That spill from that NDRC disappointment continuing. The Hang Seng Index continuing that slide, currently down by about 1.3%. HS Tech lower by 0.7%. And on that property index, a major laggard currently as a sector down more than 3%. In terms of the overall sentiment in Asia, pretty flat right now, 181.97. Is what we're looking at. It is about China. China slumping more than 5% after that wild trading day yesterday, set for its first loss in 11 days. A clear message that traders are pretty disappointed. In terms of the commodity space, that's also a reaction to what we've seen out of China. We're seeing the likes of palm oil, aluminum, copper, all slumping. Copper down about 0.8%. And that is it. From Bloomberg Markets Asia, Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.